Today, I'm going to talk about one of the best ways to finance growth to generate the greatest economic return.
The best approach to business financing growth over time is a short-term versus long-term type answer. That is, do you focus on short-term profitability or long-term profitability or both? If you have an unlimited access to a cheap source of capital, then an optimal profit focus in the short term and long term is going to be preferred, with an emphasis on accurately managing margins to gain market share as fast as possible without eroding profits. But most small to medium-sized businesses in a growth period do not have an unlimited supply of cheap money. So there's a couple of different ways to look at the best approach to financing growth. On the one hand, you can argue that it's better to grow at the speed at which your low-cost supply of money will allow you to penetrate the market. On the other hand, you could also argue that the cost of capital you're prepared to pay should be dictated by the margin you generate in the market, and that as long as you're covering your cost and believe you can gain and keep share in the mid to long term, that the speed more capital provides you is desirable as long as you can afford it. This is where many small and medium-sized businesses struggle with using asset-based lending compared to bank margining during a period of growth. Bank financing is going to be cheaper on the surface, but may not be as cheap or as flexible as you may think. For instance, if you're talking about a margining facility in the millions of dollars, you may have to provide audited financial statements on an annual basis, some pretty detailed internal monthly reporting, and potentially third-party measurement services as well. The incremental cost of these requirements can push up the effective rate considerably. But the cost is the cost, and if bank margining is cheaper, then it should be used, provided that it's also readily available and flexible enough to deal with your growth curve. This is where bank or institutional margining in the short term can be very inefficient and costly to growth, even at a lower cost of borrowing, plus the incremental administrative costs that go with that borrowing. While many banks can be very cautious with extending credit limits, and sometimes even putting the brakes on initial commitments they give you, asset-based lenders tend to follow more of a linear path, and as long as you fall within their lending ratios and maintain the quality of assets, capital availability can grow at the right speed. Once again, the key measuring stick is the collective profitability over both the short and long term. The source of capital you use at any given point in your growth cycle should provide you with the capital required to grow the market as fast as you can manage at the least amount of cost, provided you can cover the costs with the cash flow being generated. This can also mean changing from one source of capital to another over time as you grow. For instance, a business may start out with a bank or institutional working capital facility, move through one or more traditional asset-based lenders as capital demands increase, and then take a final transition back to a bank or institutional asset-based lender that can provide the best rates versus leverage when your time in business and monthly sales volumes fit their criteria. There can be tremendous challenges in figuring this out, but figure it out and stay ahead of the curve you must. Otherwise, you may lose momentum or be overtaken by someone else in the market that has done a better job of figuring out how to finance their growth.
So, if you have a business financing problem, challenge, or requirement that you need help trying to solve, then I suggest you give me a call or send me a note to the contact information at the end of this video. And I wish you all the best in your business financing endeavors. Take care.